All right, guys, let's quickly take a look then at US CPI. I think what we had yesterday with PPI kind of diffused a few expectations that, inflation wouldn't be as impactful this week. I definitely came into this week and thought, yeah, it's going to be important, but it probably won't be as important because the focus has now shifted, like we know, more towards the labor market, etc. But yesterday's reaction to PPI was pretty solid. I mean, it was the second, only the second release. Let me just show you guys that. It should be over here. Here we go. Here we can see yesterday was only the second time in the last 7 months where PPI actually had a sustainable reaction on the back of a decent miss. Over the course of the last 7 months, we had upside surprises pushing price lower, downside surprises pushing price up, and that's obviously looking at the US dollar, which has been trading more cyclical with the data. But yesterday was a pretty solid reaction, downside surprise in the data, and the dollar has been trading lower ever since. I mean, take a look at the dollar index. We're almost back down towards that 102.360 level on the back of that surprise. So certainly a much bigger reaction than what we used to out of something like PPI. And I think that just, it shows us that if we were to get a similar type of reaction or a similar type of print coming out of CPI, it can definitely still matter for the market from a volatility point of view. The one thing that is just a little bit of a caveat that we need to be a bit more careful with is that let's just assume that we do get a weaker number. The dollar has seen quite a lot of downside in a very short space of time. So the risk here is that even if we do get a weak number, that maybe at some stage we start seeing a little bit of mean reversion in this move to the downside. So we just want to be a little bit more cautious on that front. But again, if it's a super weak number, purely based on yesterday's reaction and all of the other reactions we've had out of CPI, we could continue to see the dollar push lower if the number comes in lower, for example, and vice versa. If the numbers comes in super hot today, looking for some fading opportunities in the US dollar, trading it to the upside could definitely be on the cards as well. Now, if you take a look at the historical averages for CPI, it does seem like one of the months where you have a much higher probability of CPI coming in as a disappointed print is this print, the July data that we obviously get today. So, there's a lot of things stacking towards this being a weak print. We obviously had the PPI coming in weaker yesterday. And like I said yesterday, that in itself doesn't guarantee us a weaker number. There's only been 30% of the times when both PPI headline and core surprised up or lower. There's only been 30% of the time when we've seen CPI do the same on the back of a miss or a beat in the PPI. So it's by no means a clear-cut predictor of where CPI will land, but it does seem like things are skewed more towards a weaker number. The way that I'm going to trade this, though, is playing it both ways. If it's a miss, I'll be looking to short the dollar. If it's a beat, I'll be looking to buy the dollar. What's also good about the dollar right now is that from a pure positioning point of view, the markets are basically in the sweet spot, right? We're trading very close to neutral territory on the positioning side, which makes it a lot more interesting to trade, right? It means that we don't have to be fearful of shorting it or buying it. We could do either if the numbers comes in weak enough or strong enough today. So in terms of actual numbers then, let me just quickly grab that trade plan. Oh, no, where did it go? That is just had the trade plan. Where did it go now? Here we go. So if we take a look at the numbers then, I'm going to keep it as simple as possible when it comes to CPI today. Let me show you guys what I'm talking about. Let's start with the core measure month over month. Let's just bring that on the screen. Here we go. So we know the markets are expecting this to tick up from the prior. The prior was 0.1. They're expecting it to go from 0.1 up to 0.2. In terms of what numbers I'll be looking for here, for a miss, even though 0.1 would do the trick, right? Because we can only see a very small handful of participants are even looking for 0.1. The rest are looking for a higher number. So with that in mind, 0.1 might have been good enough, but we want that ideally to come in below the prior. It doesn't always have to be below the prior, but with a number like this, I would prefer it to come in at 0 as opposed to 0.1, just to give us that slightly bigger edge in terms of the surprise factor for that print. So 0 would be my aim or my ideal dovish outcome there. It'll be below the prior and obviously a clear outlier print. It won't be below the low. but I don't think we need to get there. I think at 0 should be good enough. In terms of a hawkish outcome, going to keep it super simple there. The outlier here and the maximum expectation is 0.3. I want to ideally see it above that, because when we look at today's print, I think there's a much higher bar for a beat to be as impactful compared to that of a miss. Meaning that the number that I would want to see to give me conviction to want to trade something like the dollar on the long side or equities on the short side, purely based on the inflation print, I would need to see a pretty solid number. So 0.4 or higher, obviously, will be what I'm looking for there. That'll be a number above the max and obviously above the prior. Let's quickly take a look then at the core year-over-year number. There, markets are expecting this to drift down from 3.3 down to 3.2. In terms of numbers, I think year 3.1 will be able to do the trick. Only 2 participants are looking for that print, or for looking for a print that's as low as this. And to be fair, anything below 3.3 is already going to be below the prior, and it's going to be a new cycle low. So if we quickly take a look at the chart here, we came in at 3.3% for the core, and if I just hide the headline, you can see what I mean is that anything below that will already be a new cycle low. So even 3.2 might be able to do the trick, but again, we don't want something that's just okay as a miss. We want something that is punchy enough as a miss. If we get 3.1, it'll not just be an outlier print, but it will also be a new cycle low. It won't be just like the month of a month. It won't be below the minimum. For that, we would need to see it print at 3%. And obviously, if we get 3%, that'll be even better. But I think 3.1 should be able to do the trick as a miss. In terms of a beat, simple story, just like the month of a month, I'll be looking for a number that comes in above the market's maximum, and that'll obviously be above the prior as well. Remember, the prior for this one came in at 3.3. So at 3.4, it puts us above the max and above the prior. Let's take a look at the year-over-year the headline month-of-a-month number then. Their expectations is for this to tick up quite sizably. I mean, last time round we had a negative number. Remember, last time we came in at, where is that print now? Last time we came in at negative 0.1%. So the markets are expecting a decent pop here to the upside to 0.2. And in terms of expectations for this, or numbers for this, I think 0 is what I would be aiming for there. The reason why I would look for 0 as opposed to just looking for 0.1, because again, 0.1 will still be bad in line with consensus expectations, right? It'll still be, there's only a handful of participants looking for 0.1, but I would want something that's as close to as I can get to the prior, right? What's different between this one and the core number is the core number wasn't negative last time. It was a positive number. So the fact that this one was negative makes it a bit tricky. But I think there, anything 0 or lower will be able to do the trick. I mean, if we can stay at negative 0.1, that'll be a very big miss. But I think 0 should be able to do the trick. That'll put us, below the market's minimum, and obviously that'll be, it won't be below the prior, but it'll be a clear outlier print there as a 0 print. In terms of the beats, again, simple, just like the others, above the max and above the prior. The prior for this was obviously much lower at negative 0.1. So at 0.4, that'll be a sizable beat, but we ideally want to see that coming in above the market's max since it's a beat and not a miss. Let's quickly take a look then at headline year over year. Markets are expecting this to print flat, to stay at 3% from the prior. In terms of the miss that I'll be looking for here, 2.8 is what I would want to see. It's going to be below the prior, regardless whether it's 2.9 or 2.8. The reason why I think 2.8 will be better is there's a chunky amount of participants already looking for 2.9. Right? There's quite a few of them. If it was only 1 or 2, I think 2.9 would have been fine. And again, anything below 3% will already be a new cycle low for the headline number. So anything below 3 should be able to do the trick as a big surprise. So 2.9 should be fine or might be fine, but I like 2.8 just a little bit better because there is a big share of participants looking for 2.9 already. So 2.8 will give us a new cycle low. It'll give us a below the prior print, and it'll give us a below the minimum print as well. So that'll be quite the surprise for markets. In terms of a hawkish outcome, I think 3-1 years should be able to do the trick. Unlike the others where we were looking for a number above the max, I mean, this is just a monstrosity of an outlier, right? Only one participant, DZ Bank, looking for 3.1. At 3-1, it's already going to be above the prior as well. So again, it's not going to be above the max, but I think in this case, because it's such a clear outlier, I think 3-1, obviously or higher, will be able to surprise on the upside. Now, in terms of market reaction, let's start with the dollar. The dollar as well as yields, both of them are expecting to still trade this more cyclical, meaning if we get a bad or very low numbers, a big miss, we expect dollar and yields downside, and we expect upside on a hawkish surprise. Now, when it comes to the S&P, what yesterday's PPI did for us is it also showed us that our expectations that equities will still trade counter-cyclical to inflation data was correct. Because remember, over the course of the last 2 weeks, we've seen equities trade more cyclical with growth and labor data, right? Meaning that good labor data, good growth data has been good, bad data has been bad. But when it comes to inflation, we still expect that counter-cyclical reaction, like we mentioned yesterday. So what's good about PPI is that it showed us that our expectations for that is correct. Meaning that the way that we've been trading CPI over the course of the last few months with regards to equities, it hasn't changed, right? If we get a really bad number, we would expect that to, or low number, we would expect that to be good for equities. A really hot number, we would expect that to be bad for equities. Now, in terms of possible trade plans, I'm going to keep it super simple for today. I like the ES long and short, whether we get a massive miss or a massive beat. You know, if you take a look at what happened to the ES yesterday, momentum has turned positive enough to want me to look for more upside in the event of a nice miss today. But at the same time, we've now come very, very close back up towards that 44.50 level, which was a pretty key level of support and resistance here. You know, if you are looking for a very technical breakout, where is that chart now? Here we go. Where is that? Here we go. Is that the one? Here we go. If you're looking for a very technical breakout retest continuation opportunity, I mean, this retest, this resistance is pretty key for something like that, right? So I would trade this both up and down in terms of a big miss or a big beat. Numbers that I would be looking for, I'm going to keep it super simple. On the upside, I'll be aiming for the implied vol high. On the downside, I'll be aiming for the implied vol low. The implied vol low has some added confluence there coming in with those lows. Going back to July, which comes in at around that 5400, 5380 level. So that's a tad above the implied vol low for the day. But anything close to that, I think, should be able to do the trick. For the S&P, to the upside, you know, 5500 might be a slightly better target. 5520 in this area, you know, could be good to aim for as well if we get a nice big miss. Now, what about other markets? The dollar. When it comes to the dollar, I'm going to keep it super simple. If it's a dovish outcome, euro dollar long. If it's a hawkish outcome, that should be Kiwi dollar. Sorry, I wrote NZXD. That should be NZD, but I'm sure you guys would have figured that out anyway. But dovish outcome, euro dollar long. Hawkish outcome, Kiwi dollar short. Why euro dollar? Very simple. Yesterday had a massive reaction to PPI. Much bigger compared to the reaction that we had in the likes of the Aussie, I mean, the yen, the Swiss, the CAD. Everything else was, you know, fairly slow and small moving. The euro just absolutely came out of the blocks yesterday, punched up aggressively. Momentum is very bullish here as well. And, you know, at these levels where we're trading right now, the only key level of next resistance we have to really worry about is really that high going back up to 111.30, 111.40. So above the prior swing high, which is the 5th of August, you know, that should act as some support here for the pair. If we get a solid miss, what can we aim for? We're already trading into the implied volatility high of the session. So I'll just be looking for the second standard deviation and third standard deviation. That comes in at around the 110.70, and then the 111, I think, could be good for some upside targets as well. You know, on that, on a massive surprise to the downside. In terms of a hawkish outcome, like we said, Kiwi US dollar could be an option. Obviously, on the back of the more dovish than expected RBNZ that we had today. Keep in mind the pair is already trading, which looks like the second implied vol low of the day. Yeah, I mean, we're sitting right on top of that level. So we are already a little bit extended here, but if it's a super hawkish print, breaking below 60 would be a key test for the pair. And then we could potentially look for a move back down towards 59.60. Below that, we could even look for a move back down towards that 59.20 area. Both of those two could be attractive on a move to the downside if it's a hawkish enough print. Now, apart from that, other things we could consider, if you can trade the dollar index, maybe that's just going to be the simplest way you can trade it. What's good about the dollar index is that you get a little bit of euro exposure, bit of pound exposure, yen exposure, Swiss exposure, Aussie exposure. You get a little bit of everything. Obviously, much greater weighted towards the euro at 57%. But you get some exposure to all of them. So if you can trade the dollar index, that might just be a simpler way to go about. What's great about it, key resistance to the upside, super obvious level there. The 103, 103.20 level. You've got the psychological level, the prior top area, the implied vol high, super nice area of confluence here. To the downside, very similar story. You've got the swing low going back to the 5th. You've got the implied vol low coming in at around the 102. 10-ish, and then just below that you've got the 102 psychological, which has acted as decent support in the past. So you've got very obvious levels here to aim for to the upside as well as to the downside for the dollar index in the event of a big miss or a big beat. So that could be a fairly simple way to trade this if you don't want to have all of your eggs in one basket, so to speak. Now, don't throw away something like the dollar yen on a miss as well. The dollar yen could definitely see a break, but I'm a bit disappointed with the lack of reaction we had in the dollar yen yesterday out of PPI. Again, if you compare what happened to the euro and even sterling and even the Kiwi yesterday, to be fair, on the back of that PPI, I mean, the yen barely moved and yields did push lower. So it might be showing us a little bit of exhaustion on some of those yen moves. So nothing wrong looking for a crack below this level, looking to trade this lower. I do still like dollar yen lower, but keep in mind that it wasn't the best of movers yesterday. And if we see, I think the reason for that is because yesterday saw risk on, right? We saw that classic risk on environment on the lower PPI, which sent the high betas higher and the safe havens lower. And we might see the same thing today, meaning that even if we do get a miss, even if we expect the dollar to go down, we might see the yen go down as well. Similar story to the Swiss franc. So it's just something worth keeping in mind as a bit of a caveat. So with that said, that's the preview for US CPI coming up. As always, any questions, don't hesitate to let me know.